Okay, a warm welcome to all our guests. This is our first masterclass as ACES. My name is Arasia Nyawade, and I'm head of marketing and communications here. So today we have the awesome team at Zeitec Investment. They will be leading us through a powerful masterclass on portfolio management. So I hope you are ready to learn something. But before we start, I want us to get some housekeeping out of the way and just get to understand how we can use the platform to encourage the facilitators. So at the bottom of your screen, there is a smiley face emoji that has reactions. So if you can see it, please click on it and get onto the thumbs up so I can see that we've all found it. Awesome. So if you like a point that has been shared, please do feel free to use that. A quick wave, which is the third emoji, just to say hello to everyone. And then finally, because we're a group of investors, let's click on the money emoji because we know what that's all about. So if you received my email an hour ago, I would also like to encourage us to please participate on the socials, especially on Twitter. X. If there's something that's going on there, please, there's some point that you have found to be profound or you would like to share with your fellow investors, please follow the conversation on there. Our page is ACES_summit. I have it on the front channel right now as a comment. And then tag us so that we can repost your comments as well. So there's exciting stuff happening at ACES this year. And one of the coolest things that is coming up soon on September 7th is the investor meetup. And that's where we're virtual right now in the masterclass, but that's where you'll have an opportunity to meet your fellow colleagues in person in a city near you. So that's happening on September 7th, kicking off with 4 cities. That's Amsterdam, Austin, and Dallas in Texas, and finally New York. Then after that, leading up to the main summit in November, December, is going to be October 5th. So that's for all the African cities. If you're an investor within the continent, please do check out our website and register. Don't just see it and say, oh, okay, cool, I'll keep it in mind and forget. Please register so that you can get all the info and attend leading up to our main summit on November 30th to December 1st. So right now, I think that's it for us. Please interact, please enjoy, and I will hand over the mic to Mr. TD. TD, please welcome on stage and take over as you lead us through a lovely masterclass. Thank you so much, everyone. Enjoy.
Quick question. How do I present? Fantastic. Thank you very much and welcome everybody. I would like to welcome you to the first in our series of masterclasses by the African Early Stage Investment Summit Group. And today we're going to be taking a deep dive into portfolio management, looking, really at early stage tech startups as an asset class. And to do that, how do I click next page? I've got with me here the Zeitec team, and if each of you would be kind enough to say a quick hello. My co-founder, Erick Young. Erick, please say hello.
Hello, hi everyone.
I've got another my co-founder with me, Ben Lebois.
Hi everyone. Wonderful to be here.
and our CTO, Mr. Falami Benedict. Say hello.
Hello, everyone. I'm excited to be here.
Yeah. Unfortunately, Bertrand could not join us today, but he sends his best regards. Next slide. Now, what we're going to be going through today is our guide to portfolio management. We'll talk about, we really want to understand who's in the audience and what your pain points are. And to that effect, we're going to actually ask you to answer a few questions before we proceed. Then we'll take you through how we see early stage tech as an asset class and the Zeitec Playbook in terms of how we manage it. And finally, Erick is going to talk us through some real life examples from the Zeitec Playbook. I trust that works for you all. So without much ado, let's move into what exactly are you as an early stage investor seeing as the challenges? Okay, we see the asset in your portfolio through their life cycles. And in each phase, we strive to understand your pain points and priorities. Asset tracking, supporting founders, or exits. And under each of these come through, a multitude of activities that as angel investors, early stage investors, you actually should be actively pursuing to get to that final stage of it, which I say it's not the exits, it's actually the returns. Okay, so if you'd go to the next, please, can you, okay, it's a 3-minute survey, okay, and I need everybody here to please take this survey, scan it, take the URL, okay, as you do, guess what? We're going to see the results. So please, let's take the time out. We're waiting on you, Ben.
So we'll give everyone maybe 3 minutes here just to kind of run through this. And at the conclusion of 3 minutes, we'll share the results from you all to show a little bit about who's in the room, but also what your pain points are, what your priorities are. So if you could, please go through at the end of 3 minutes. I'll check to make sure everyone has had a chance, and then we'll share the results.
Okie dokie. So while we wait for you, okay, to please tell us who we're talking to. What I'll share with you is my favorite poem. It's by a gentleman called Max Bryan. And what does he say in Desiderata? He says, you go quietly, okay, amid the noise and the haste, and you can remember what peace there may be in silence. As far as possible, without surrender, be on good terms with all persons. Speak your truth quietly and clearly, and listen to others, even the dull and ignorant. They too, they have their own stories. You should really avoid loud and aggressive persons. Do you know why? They're vexations to the spirit. But then, if you compare yourself to others, one or two things are going to happen. Okay, you're going to either become vain or bitter. For always, they're going to be greater or lesser persons than yourself. Avoid loud and aggressive persons because they're just vexations to the spirit. But enjoy your achievements as well as your plans and keep interested within your own career, however humble. It's actually a real possession, the changing fortunes of time. Exercise caution in your business affairs. For the world is full of what we would call 419 in Nigeria. It's full of trickery. But let this not blind you to what virtue there is. Many people strive for high ideals, and everywhere life is full of heroism. Please fill the survey so we can find out about you and we can address this session
And if we
to
can
your
get
needs.
anyone who has not had a chance to finish the survey, please throw up a wave emoji. If I don't see a lot of waves, I'll assume that everybody, okay, so we'll give a couple more minutes. It looks like some
Okay.
folks are still filling it out. So 1 or 2 more minutes, I'll
Fantastic.
check back in and we will see if everybody has completed by then and share the results.
Okay, so back to Desiderata. Desiderata says, be yourself, especially do not feign affection, but then neither be cynical about love. For in the face of all aridity and disenchantment, guess what? It's as perennial as the grass. Take kindly the counsel of the years, gracefully surrendering the things of youth, and nurture strength of spirit to shield you in sudden misfortune. But then don't distress yourself with dark imaginings, for many fears are born of fatigue and loneliness. So Max says, beyond the wholesome discipline, be gentle with yourself. You are a child of the universe, no less than the trees and the stars. You have a right to be here. And whether or not it is clear to you, there's absolutely no doubt that the universe is unfolding as it should. Therefore, be at peace with God. Whatever you conceive him to be, and whatever your labors and aspirations, in the noisy confusion we call life, keep peace in your soul. With all its sham, drudgery, and even broken dreams, it's still a beautiful world. So be cheerful and strive to be happy. That is Desiderata by Max Ehrmann, written in 1927. I trust you enjoyed that. That's our 3 minutes up. How are we doing?
Can we get any show of hands of anyone still completing the survey? I think we'll go ahead and jump into presenting. And if you're still completing some answers, don't worry, they will populate in real time. And the goal really with what we want to do in this section is, 1, to show you all who's in the room today. But 2, what we're also wanting to do is show you how much in common you have with each other in terms of the challenges you face and the goals that you have. And hopefully through the rest of this masterclass, what you'll be able to do is see what are the challenges that we're all facing together, and how do the learnings that we're getting from this masterclass help us to confront those challenges. So that's the goal. With that, I'm going to share some exciting poll results here. Okay, so there's still 11 people completing, but we'll jump in and see the 17 that have done so far. So what are we seeing first and foremost? Overwhelmingly, we're seeing today these responses, these challenges, these priorities that we're going to be hearing about in the next questions are mainly coming from investors based in the continents, right? We have some other investors, it looks like, here from North America and Europe as well, but just framing that the responses we're going to see here from your contemporaries, these are contemporaries that you have a lot in common with in terms of where you're based. 46% venture capital firms and 33% angel investors or syndicates. So we're looking at a huge contingent, 79% of you whose main goal is finding and funding the next big thing. So again, a lot in common here. And we'll see how that 79% of you, I know that there's some startups here, some ESOs, but how that 79% of you, what are those challenges and those priorities you have? Looking at targeted returns, some interesting results here. We're seeing here really the overwhelming majority so far, looking like around 70%, somewhere between 2 to 10x return in that, less than 5 to 7 year, 5 to 7 timeline. But what we also see
2 to 10, 5 to 7.
Yeah.
Mm-hmm.
what I also want to point out here is down here, this is not a small number either, of 16% of whom don't have a specific return targeted. And that's something that we're gonna talk about a little bit today, of how planning for exits, how managing and curating portfolios, having a strategy to lead with is so tied to your efforts. But some interesting results to see that we've got a lot of you focusing on a very similar sweet spot of returns, but we do have a good contingent here who are still somewhat investing without a more specific or articulated return strategy. So how are you all implementing strategies to guide your scope and your return targets? Almost half of you are saying that you're actively managing your own portfolios, and another 40% of you are taking a strategy of trying to co-invest instead with maybe lead investors who do that and are sort of structured in their own way. I think the summary that I take looking at this is that if you look at this 88%, so 48% of you are doing hands-on portfolio management, 40% of you are hoping to invest with investors that you believe are doing portfolio management. What we're looking at here is theoretically 88% of these assets should be getting managed under portfolio. So let's see what the responses are to the next questions about how that's going. Well, most of you say that you're spending either most of your time mentoring startups, cultivating a network of follow-on investors, or prospecting new startups to invest in. But when we go to how that's going, as far as your challenges, getting information from founders and managing your portfolio, missing key data or metrics is almost half of the responses. So I'm just going to do a little bit of seesawing, so please don't get, hope you don't get seasick with this. I want to go back to this slide here. Theoretically, in the room today, 88% of the startup assets being invested in, the investors here believe that those are going to be actively managed and are going to have active portfolio management over them. But when we go forward to the biggest challenges, we're seeing almost half of the responses saying missing key data and metrics as a very common large challenge that you face in working with founders. So even though 88% of these assets should theoretically be under portfolio management, what we're seeing here is that is not a guarantee that portfolio management is going to lead to strong tracking and strong transparency on how that asset is progressing. We're also seeing, right, non-responsiveness and inconsistent late reporting as significant issues, as well as the data not fitting the investor needs for whatever they might need it for, whether it's audit, maybe it's presenting it for follow-on investors. The data or reports that you're getting from your startups are not meeting the threshold, the minimum threshold of utility for what you're going to really be using them for. So we're seeing a huge effort being done in this room today, either directly or indirectly, in managing these assets and startups. But what we're seeing is that in practice, it's a tough thing to implement. And there's a lot of challenges popping up for most of you. And a lot of them, if we tally up just the top three, accounting for approximately 75% of the challenges that you face in getting information. So what are the people in the room today doing to improve that? So we have some folks here who are using digital self-service platforms like Rundit or Investory, where startups are sort of reporting on their own, and there's some automation there. We have even more of you manually reaching out to founders. God bless all of you. We know that's a big challenge. And then we have some of you who are really engaging even more proactively or more granularly with your founders, which is going in one-on-one calls or coaching them. What's interesting, and again, this matches up really well to what we're seeing with the 88% of you engaging either directly or indirectly in portfolio management, is that none of you said that you're doing nothing. And so what that tells us is that 88% of you are actively managing, you're experiencing those challenges we saw before, and all of you are trying something to improve it, right? You're doing something. But whether or not that's having improvement, right, I'm sure there's mixed results there as well. Now, we've talked about asset tracking, but the next phase, as TD pointed out, which is really supporting founders and helping them grow and helping them scale, solve problems, be able to get from one step to the next, that's a big part of the journey as well. When we ask you what's the biggest challenge that you have in trying to support founders, two huge things that jump out at me here are a lack of expertise or not knowing what they need help with. And I point both of these out because if you add those two up, that's over half of the responses that we're getting from you all. And in both of these cases, one, the lack of expertise is going to be linked to the fact that ultimately at the end of the day, you may not have the answer to every question, but is there a network of knowledge somewhere that does have the answer that you can leverage? And the second, not knowing what they need help with, is typically very tied to how strongly is the startup engaging in reporting, in providing with us in both quantitative and qualitative information. So what we're seeing here, the challenges in supporting founders are very much linked to also the challenges in tracking, monitoring, and reporting with founders and startups. We do see 4% of you say that there's no challenges to encounter when supporting your founders in your portfolio. I would love to take conversations offline with that 4% of you to hear what it is you're doing, as I'm sure that there's some interesting strategies you're using. But we're seeing here overwhelmingly 92% of you, or sorry, excuse me, 96% of you are experiencing challenges. So with that, if we go back now to TD, into our presentation and into our masterclass, we enter what TD had prefaced, which is when we're talking about managing portfolios and achieving success and overcoming challenges, we have to first really discuss these startups and these assets as an asset class. TD, I'll let you take the next slide away.
What these slides tell us, okay, is that first and foremost, if we look at Africa as a continent, our rate of return, our internal rate of return for assets is lower than the norm across the piece. That's top right-hand corner, and you need to sort of keep that in the back of your head. As long as you're on the continent, the returns you can expect cannot be the same, okay, as Europe, where it's highest, or the US, where it's next, or even the Asia Pacific. So that's sort of the first thing you need to do. The second is then to look at the nature of the investors. So if you look, yes, VC has the highest return, internal rate of return, in the high 20s, depending on, that is if you're in the top quartile of VCs. And this is in comparison to other investment asset classes like real estate, okay, and of course the S&P 500. But by and large, okay, when it comes to the continent, what we've discovered over the last 5 years is that over 70%, in fact, as high as 90%, earlier on, it's just a few people have bumped up Series A, are actually at pre-seed and seed, so very early stage funding. So there isn't that much going into later stages by comparison. And that sort of sets the context in terms of where the returns, okay, are at. But if you go to the next slide, Ben. Yeah. Here's really what I need you to take a hard look at is where do those acquisitions come from? By far and large, even in the mature markets, guess what? It's all about, surprise, surprise, acquisitions. Okay? Acquisitions remain bar none, okay, the way startup, if you are an early stage investor, I'd say nine, in fact, Ben's going to show us later. I think 9 out of 10, it's going to be by acquisition. And for angel and seed investors, these opportunities don't even come around that often. And I think Erick's going to tell you a story. Uh, I call it the ouch story, which I want to hear if that's happened to any of you before. Well, some of you may not even know if it's happened to you, and that's the fascinating thing about it. But the key takeaway, okay, I want you to keep it back ahead is this. We all talk about unicorns, we all talk about IPOs and, Nirvana and all of that. But if you are a serious-minded early stage investor, keep in the back of your head, it's going to be about acquisitions or secondaries.
Yeah.
So that's the critical thing about this asset class.
Absolutely. And if
you go to the next slide in terms of what does that really mean? Okay. Sorry, Ben, you wanted to say something. The key point I wanted people to take away, okay, I think was emphasized by what we got from the audience, which is where I think it's clearly 90% of them are actually doing something, okay, about managing portfolio. And the key point being exits don't just happen. You're not just going to wake up one day and get a call and say, oh, by the way, you can come collect your cash. We've sold and there's an exit. It is something you have to proactively work on, okay, over a period of time. And that's really what we want to talk to you about today. Yes, Ben.
Absolutely. And to echo TD's point, the reason we wanted to show that first slide of data on returns is that if we see a top quartile VC fund getting a 25% rate of return and the lowest getting a 9%, lowest quartile getting a 9% rate of return, if we combine that with the fact that 70+% of investment right now in tech in the continent is seed or pre-seed, and we know that acquisitions are by far and large the most common type of exit, what that tells us is there is a huge variance in what your potential outcomes are depending on the performance of your fund or your assets. And because most of the capital is going very early, we really should be talking about proactively curating, managing, and guiding these assets towards that acquisition opportunity. And those opportunities, how you make sure that they are ripe, how you make sure that they're available, that's what we're going to be talking about next in this section, which is going through the Zeitec Playbook. TD.
So over to you, Ben. Please take us through the Zeitec Playbook.
So we like to begin with the quote that really runs our philosophy at Zeitec, and it's centered exactly on what TD touched on, which is if we fail to prepare, we should prepare to fail. And what we really mean by that is we do not believe that the asset class as it stands today and in how you should approach portfolio management is a invest and wait it out asset class. We don't believe in that thesis. We believe that the thesis today is invest in very good assets that you believe in and curate and carefully guide them towards opportunities and make sure that you are ready for those opportunities when they present themselves. So we're going to use a little the emoji function again that we talked about earlier. If you look here, this is a standard VC Series A checklist. This is the one that Y Combinator uses. It's one that many different VC funds and Series A investors use. If we can use a show of hands for the emoji with the emoji function. How many of you today believe that your assets or startups in portfolio would meet this entire checklist? I'm seeing a lot less hands than I saw for the survey. And that's unsurprising because it matches exactly what Zeitec is seeing every day on the continent, which is we see that, in fact, most of these, and again, over 70% of the capital is going into pre-seed and seed. What's the next round? It's Series A. And we are overwhelmingly seeing that most startups are not even ready on a third of these items that standard Series A investors are going to be looking for. So what does that mean? It means that these assets are not investor ready, which means that they may not actually be ready for a Series A investment. And even if they are, but they haven't formalized this documentation, this tracking, this reporting, and been able to embed it into their workflows, investors are either going to A, see this as a sign of concern that they don't have these things together, or B, they will also just walk away from the deal and saying, we're not going to wait for you to get this stuff together. I know that in 2021 and early 2022, startups had a lot more capital coming in, and so there was a lot more power on the startup side. So maybe some startups felt that they didn't need to necessarily have all of this due diligence prepared in advance. The reality in 2023, as most of you know, is very different. Investors have less capital that they're putting to work. So that means the follow-on investors that you all are hoping to get invest in your portfolio companies, they have less capital. And so they're going to be more demanding of startups. So it is even more crucial now than it has ever been that startups be able to meet minimum due diligence requirements. So how does Zeitec assess that? Well, we really look at designing a playbook that optimizes monitoring and reporting. So making sure that we are consistently getting the information required for that due diligence to understand where an asset is and to make sure it is primed for a follow-on investment or for an exit. We view managing risk as the second layer of that. Once we have information, what do we do with that information? How do we optimize an investor's portfolio? Are we looking, now that we have all the information and we're getting all data from all of the portfolio companies, where do we want to allocate most resources to promoting which startups that we think have the best chance? How do we want to maybe strategize for some assets? We might look for a really early exit if we're not confident about the long term. The managing risk and building the strategy around risk can only happen if you actually have the information. Our third layer is, once we've devised that strategy based on the data that we're getting, how do we add the value that we think is necessary to these portfolio companies? As I mentioned, in many of our investors' portfolio cases, we have some startups that are performing exceedingly well, and our value may just really be focused on helping to connect them with future investors, helping to promote them. We may have some startups that are somewhere on the brink. They could really scale up and do really well if they unlock some bottlenecks. Can we bring in some experts? You all mentioned that often you feel you do not have the expertise yourself to be able to help these startups. Can Zeitec bring in some external experts to help troubleshoot and problem solve? And then, of course, getting to portfolio optimization, making sure that the portfolio is ready within the targeted exit strategy, and of course, realizing exits. But what we're seeing here, the two big takeaways from this slide that I want you to take in from the Zeitec playbook generally, is that nothing can happen if we do not get consistent, high quality, and fit for purpose data and information from assets. If we don't get that information, and when I say we, I'm talking about Zeitec, but I'm talking about investors generally. If we don't get that information, all of the next steps, managing risks, adding value, optimization, and executing exits, they are all going to be haphazard and based on incorrect or incomplete information, which is going to make us inefficient. So everything begins with that first layer, which is so difficult, as you guys all mentioned, in listing the challenges that you had.
And I can, you see, you can't overemphasize the significance of that. Because as Ben just said, without data, you don't have anything. So you need to realize and you need to recognize that the relationship with the startup becomes a critical component. The ongoing relationship where that data comes regularly and accurately becomes a critical component of the relationship. Now, next slide. If we look at providing value to the portfolio companies, and I'm glad to see that 48% of you said you actually do that, then you know that it can take, in fact, less than 3 minutes for an expert to solve a problem that a startup, could take months. And I've seen in one particular case, a founder broke out in tears because he'd been at a particular problem for 4.5 months, and one sentence, from an expert just blew it away. One sentence. And he'd been at it for months, agonizing, testing, and everything else. So the point is, there are different aspects, and I think my poem framework, everybody knows about now, actually addresses what different areas of a startup you need to build. But Ben, I thought, if you'd pick one or two of these areas just to bring to life what we mean, by growth hacking, or what exactly about fundraising, take two and just help the audience understand, the value creation in portfolio companies.
Absolutely. So the first thing we'll say with Zeitec is that, while we certainly believe in the strength of our team, what we know is that we do not have all of the answers to every startup's problem. And so what we've done is we've gone out and curated a network of experts, whether that's current and former founders turned VCs, high-level startup operators, people who have really specific subject matter expertise across different business models. And we've curated that network so that we can tap these people to come in for these 3-minute conversations. So I'm going to give 2 examples. The first I'm going to give is around growth hacking. So there is a Francophone West African startup that initially was sort of trying to compete in the food delivery sort of business, competing with Jumia, Uber Eats, whomever it may be, within Francophone West African markets. And their view was, we can compete because if we're native from Francophone West Africa, we have a home advantage here. And what they started running into was that they essentially were onboarding customers, losing customers, onboarding customers, losing customers, and they couldn't quite find a way to sustain their growth, which was minimizing customer churn and continuing to grow organic customer acquisition, or through low customer acquisition costs and high retention. So they approached us and they say, look, we have this problem. We are onboarding customers, we're paying customer acquisition costs, we're losing them after 3 months, and we're basically just cycling through new customers without experiencing any real growth. So we looked into our network. I paired them with the head of growth from Vimeo. I'm assuming that people on this call know who Vimeo is. So one of the heads of growth at Vimeo, who's a guy named Ross Nazarenko, worked with this startup for 15 minutes and essentially identified that the reason that they were having this massive customer churn was that they were actually dumping their customer acquisition cost into the completely wrong funnels, and by doing that, acquiring customers who were not really looking to be high loyalty customers and who were going to be more, can I save 50 cents through this delivery service versus that one, and doing that calculation every time. Those were customers that were not really ideal for managing growth and having high retention. So Ross worked with the startup, completely changed the customer acquisition funnels and this was in 15 minutes, completely changed what funnels they should be targeting by looking at the other funnels they had that they were not really maybe paying attention to as much. And the result was essentially that month over month after Ross coming in, this startup started to see a 40% month over month user growth. But most importantly, their churn went from about an 85% 3-month churn rate, so losing customers at 85% rate over 3 months, down to 27%. So they were getting much more also financially effective in how they were spending their money. So that's one example. Another is an example of a startup that many startups face this challenge. Early pre-seed going to seed stage startup that was pitching itself to investors for a seed round and was kind of wondering why they weren't getting traction. And the majority of investors were essentially responding to them and saying, we don't believe that you are on the road to product market fit. We think that you have some early traction numbers, but we don't really think that these numbers are representative of a startup that's going to achieve product market fit. So the startup, we were working with them, we paired them with a growth hacking and product market fit hacking engineer named Sergey Keller, who has a incredibly successful consulting business called Gosu Team that has done consulting work on product market fit for companies like Bolt and Printify and Printful, a few others, just to name a couple off the top of my head. And essentially what he implemented with this startup, again, this was, I believe this was a 30-minute conversation max, was a framework for the startup to actually be measuring with customer behaviors and customer onboarding and customer churn, whether or not their exact offering was leading to product market fit and which parts of the product were the best parts of the product that customers really loved and which were parts of the product that didn't matter at all. And what that allowed this startup to do is over the course of 6 months, they were able to pivot their product a little bit, refine it, focus on the highest value add areas. Their traction numbers increased immensely. They went from, I believe, customers responding, about 18% of them were saying initially that they would be very disappointed if the product went away, which is a standard survey question for finding product market fit. At the end of the 6 months, that number was at 72%. And they did subsequently successfully raise their seed round with a few of the same investors who had previously said no. So this is the premise of what we see in the supporting startups phase, is that none of us as investors have all the answers. We have some of the answers, but most of them we do not have the answers to. Can we leverage other people? And the reason it being so important, to borrow TD's mantra that he has told me many times, is that if startups are defined by being on a funding journey, time is money. And a startup that takes 4 months longer to figure out that product market fit example I just gave is a startup that may run out of runway. And so that's kind of how we implement that model. TD, anything you want to add here?
Well, I was going to wrap it up just by helping the audience understand what we're saying is, look, first and foremost, you have to even know what's happening within the startup.
Yeah.
That's the first thing, is you've got to know what's their pain point today. First question. Do you have the relationship to be able to get the information behind the pain point? So it's about the relationships with the startups to understand the problem enough to be able to identify those who can solve those problems. And that's why, as Ben said at the beginning, you're starting to see the importance of data. Because I've had situations where, because I was getting data regularly, there was one particular situation I knew more than the CEO about what was happening in that particular, with a particular set of problems that his team had brought to him. So it's about understanding what's happening inside the organization, not always being the problem solver, but at least helping to identify what that problem is and who therefore can provide them with the solution that they need. That's the critical component. Next slide. So next up is really about how you drive returns, okay? And Ben, this is where the alchemy of portfolio management, okay? For those of you who aren't familiar with the power law or the power rule, it's called Pareto's rule. You can call it, it comes in different, but essentially what you will find is 80% of your returns are going to come from 20% of your portfolio. Ben.
Yeah, absolutely. So if we think back to the Zeitec Playbook, we have to collect data. We have to, once we have that data, manage risk by adapting the portfolio strategy. We have to support founders. We're starting to arrive to the point of, okay, so now what do we do? How do we drive returns? And the first thing I want to point out is, and this, these numbers that you're seeing here are actually from my own portfolio with a angel syndicate that I co-founded in the Baltics. So these numbers you're seeing of returns are the actual returns that were generated by a mini fund of 6 startups that we invested in. One with a 1000x return on our investment, which did very well. One with 100x, one with the 20x, and 3 that failed. This was an exceedingly well-performing portfolio. The majority of our portfolios that we see is it's going to be maybe just 1 or 2 that generate any kind of return, 4 that generate no return. And so what we're really looking at here is when we get to the part of trying to drive returns, it is absolutely critical that as investors, and in Zeitec's case, as portfolio managers and asset managers of investors, that we know where to allocate our efforts and resources. Because if we are perpetually spending 80% of our time with startup F or startup E, and then at the end of a fund's life cycle, we're seeing a 1.5x return back to investors, there is a relationship there. At a certain point in time, we have to be focusing our efforts and resources towards the startups that are going to be yielding these outsized returns, because that is how the business model works. Overwhelmingly, usually at least 4, in this example, I've given a very kind and high-performing example. Overwhelmingly, you're going to see, in a case of these 6, at least 4 that are not going to make it, maybe 1 that's going to generate a modest return or a good return, a solid return. And that 25x return that we saw from the top quartile of VCs, remember we saw in that first slide that the top quartile of VCs generate a 25x internal rate of return. That's the expectation. Those are the ones that are funneling resources towards startup A. Those funds are able to get data, synthesize it into a strategy, support the founders, and funnel resources towards the places that are going to give that outsized return. And that 1000x return on startup A, that is what's going to lead to the 25x IRR for a top quartile VC. TD.
Exactly. Yep. And, you know, to sort of drive home the point, my mentor, David S. Rose, you know, says startups is a numbers game. And this is why it's a numbers game, because nobody knows which startup is not going to fail. Mm-hmm. So what you have to do, and this is why we're in the game, is you have to look across a spectrum to understand where the synergies are. Okay, so that the ones that are moving at the pace that you need, you can allocate, as Ben was saying, allocate the right kind of resources. And the ones that aren't, you know, it's brutally honest, you know, make sure you find a way, you know, to mitigate the risks associated with disengaging with them. And that's the reality of the game we're playing.
Yeah. And if I can give a nice public example that I think everyone will relate to, I'm going to ask you all to use the emoji function again. Please raise your hand, the emoji hand, if you have heard of the company Twitch, the startup Twitch. Let me see some hands go up. Okay, so I'm seeing some hands go up. Okay, so Twitch's latest valuation was $20 billion. Okay, they exited from the founders who founded Twitch. There's 4 founders exited. They'll tell you a little bit early at $1.2 billion. They exited, and then Twitch has gone on to 20x that in their valuation, but they still exited at 1.2, which is not too bad. So these 4 founders originally pitched their startup at Y Combinator, and the startup was called Justin TV. And they had 4 founders, and one of the founders' name was Justin. And their plan was to strap a camera to Justin's head and live stream what he does every day walking around. This is around like 2007, 2008. So their startup's pitch was, we're just going to strap a camera to Justin's head, and he's going to walk around, and we're just going to live stream what he does every day. And most investors, as you all are probably remarking, as I would remark, that sounds incredibly stupid. I don't know where the money is in that. I have no idea why you would ever do that. But essentially what ended up happening is that one of the Y Combinator investors was just very amused by it and invested, and just started taking a keen interest in following their traction. Justin TV went through a number of pivots, but what he ended up seeing in traction was these guys are really on to something with this idea that people want to see real life streamed online by real people and not curated reality TV. And what led in the subsequent years was Twitch, which became a 1.2 billion exit and then a $20 billion company. And the reason I bring up this example is that the only reason that the investor stuck around, and he would tell you this, Paul Berhalter, who's at Y Combinator, is that he stayed very close to the founders, was perpetually getting reports from them on what they were doing, and he was always impressed by their resilience, ability to pivot, and ability to find new customer segments that were willing to pay money for stuff that he seemingly, when he had first saw that pitch, was like, how would anybody pay for this? So I give that example because it's a very playful example. It's also a very relatable or known example, excuse me. But it really illustrates that the only way that you can identify a startup, as TD mentioned, we have no idea really when we invest in a startup at the start, who is going to succeed and who's going to fail. And the only reason, the only way that we can know progressively how those probability numbers start to shift is through that tracking and knowing how assets are progressing. So a little playful anecdote from there. TD.
Yes. So as you start to orchestrate the portfolio, there are different techniques that then kick in. And these are not new. They've been around for, intangible asset management for quite a while. And they therefore apply, okay, to a portfolio, an aggregate portfolio of startups, because you would then be privy, if you have the data, to seeing and analyzing patterns people would otherwise not see. If somebody had told you 20 years ago that Africa could create 7 unicorns within a decade, you probably would have laughed. So again, the focal point is the last slide, which is the returns. Exits mean returns. And the reason you're in is exactly that. Now, in terms of realizing exits, go for it, Ben.
So we showed you some data at the top of the presentation around probability of exit. But now that we've walked you through the playbook, which begins with data tracking, goes through managing risk and curating strategy, supporting founders, and optimizing portfolio and priming it for exit, where do we land now? We land now in a situation where 95% of the exit opportunities that are going to be there, and this is even higher for investors who are investing at the pre-seed and seed stage, 95+% are going to be through acquisitions, different manners of acquisitions, but typically just standard acquisitions, or secondary sales. This 5% IPO is a very generous number. It's a very generous number.
It's more like 1.5.
Yeah, 95% plus percent of your exit opportunities are going to be through secondary sales and acquisitions. So the challenge that many investors, and this is true globally, but this is even more true on the continent where the transparency of what other startups are doing what corporate companies might be interested in what startups, do the corporate companies even know about startup X or Y? Because the transparency of what is happening is so much lower, it makes the two highest probability categories, acquisition and secondary, exceedingly difficult unless you have very good visibility on what is happening on the continent and you have assets that are ready and primed for these opportunities of secondaries and acquisitions. So our focus with Zeitec is doing all the efforts that we mentioned that, yes, we're talking about exits on this slide. The exits cannot happen if we do not have really good data that allows these assets to be ready, great visibility on the assets, and funneling of resources towards the ones that we know in looking at the market of potential buyers or potential secondary follow-ons. Let's funnel resources towards the assets that we think, in knowing what's going on in the market, have the best chance for these two categories, secondary and acquisition. And you may have, for example, in that vein, a startup in your portfolio that has little to no revenue traction, but has fantastic IP that if you know about other players in the market, whether it's corporate players, other startups that are more advanced that could use that IP, unless you know about them, this category of acquisition is off the table. And you actually may not end up funneling any resources to that startup because you may not see it as high potential due to lower revenues. Similarly, in the secondary category, you may look at a startup and see it as, okay, well, they're going to go raise a Series A round, they're going to fill that round. But are you looking at, is it possible to connect this startup with investors who we know have a lot of dry powder and are being aggressive in this market or in this sector and may be willing to oversubscribe? And have we talked to the founder about whether they're open to an oversubscription? And in that scenario, are they open to us using an oversubscription to exit? These are all things that have to take place and have to be meticulously done in order for these two categories, secondary or acquisition, to happen. And for investors who can't or don't want to put in that sort of preparation for this, then you're banking on this very generous 5%, which is in more likely, as TD pointed out, 1.5% or less. And this these numbers are not numbers of total startups. These numbers are percentages based on startups that actually do even exit.
Exactly.
So really, really important to understand that the thesis here is that your overwhelmingly most likely route is through these two funnels, but both of these funnels require very intentional preparation, of which we are seeing as Zeitec and talking to investors on the continent is not happening at a high enough threshold of quality or preparation, either because those investors need more help, those investors need support, startups are not sort of understanding the importance of this message, any number of reasons. That's what we are actively working on. TD.
Okay. Thanks a lot, Ben. And, on realizing exits, I hope the audience is listening aggressively, because the picture Ben has painted is one that most of us carry in our heads is, oh, we're going to get to that IPO. Well, Flutterwave is waiting to IPO. Other than them, I don't think I can think of any other startup. I think the last one was Jumia. So you start to get an idea of the frequency of IPOs, and even if startups get there. But at the same time, just go take a look at how many startups have been acquired by Google. I'll leave it at that, okay? Because rather than us supposing and hypothesizing, we have a little bit of time left. What I'd like to do now is bring it to life. And to do that, I'm going to bring on board our third co-founder, Mr. Erick Young, who is going to tell you that that's actually why he founded Zeitec. Go. You're on mute.
Okay.
Thank you. Go for it.
Thank you, Didi. Thank you, Ben. Thank you for the learnings. And definitely, I think it's very, very critical. And it's very, very critical at the stage where the ecosystem is. As now we have seen the increase of capital allocations. And of course, like everybody, we would like to have the experience of closing that cycle of investment by exiting. And as some of you know, during the last 9 to 10 years, I've been CEOs of Green Tech Capital. We've been investing in 40 companies, mostly early stage companies in Africa. And obviously, like any organizations, we were really looking forward for opportunity for exit. And I had a couple of experiences that I would like to share that brought me to understand that there is a specific effort to do when it comes to portfolio management. The first experience is regarding a secondary market. And that's really that we had, like Ben mentioned, we had different companies. Some companies were performing very well. We had a team of analysts following the startup. It's definitely an advantage to have a large organization, because then you can allocate resources and you can have you have a higher chance to get data, which still in that case we find ourselves in a situation where we don't get all the information. What happened is that we had one company, I would not disclose the name of the organizations, but basically these companies wanted to raise 5 to 6 million. So we're quite happy.
Ben, you can go off camera. Sorry,
that's all good. We were quite happy. We were quite happy because every time that a company raised is basically that, okay, the paper value is going to increase. What we did not know is that during that raise, we will get a call from the founder saying, hey, we have extra money, and would you like to exit your shares? We did not have planned that scenarios. And what happened is that the same way he called us, he called all the other investors, okay? And some of those who were prepared have been very reactive, meaning that I guess that in less than 24 hours, they're saying, yes, I would like to exit, and others said no. But in our case, what we did is like we tried to balance and say, okay, what's the perspective, what we're going to see, etc., etc. And we were, like being a little bit surprised by the opportunities. And what happened at the end of this is that when we decided to say, okay, yes, we would like to do that sales, then the possibility were already gone, because there was an extra million, but that million was already, and the deal was done already other stakeholders. As the consequences, we missed that exit opportunities. And that really what we see as very, very important when we look at portfolio management. Because portfolio management provides you information to evaluate the risk and opportunity very quickly, and be able to be efficient in your decision, in your capital allocations, in the reduction of the risk. And that is really how we actually see that. And that experience has taught me that the portfolio management has to be used not only as a tool of collecting the information, because a lot of investors I'm talking to, they say, oh, yeah, I received some metrics, they're not complete, but it's okay. And the moment where they have challenges is basically if they have LPs and then they have to do the audit. And they say, oh, that's the moment where I'm trying to run after founders and get information. So in our case, we had the hard lessons to learn that during by missing a secondary sales, but some others investors that will be different case. And that's how I start thinking in terms of how can we help more people to get the information for the portfolio management and being able to provide them the information to help them take decision very quickly by saying that, okay, hey, if you get that opportunity and then you get an acquisitions, or if you get a secondary sales, okay, take that because that will likely not happen right away, etc., etc., etc. That is one experience that I would like to share. There's another experience I think that is quite important because that was a painful experience because like a $250,000 experience is quite painful, but then you had the other good experience. Once you have this experience, and in the other case, we started to look at the exit really like if the exit are not going to happen by ourselves, because when you look at secondary sales, this is really something that's happening. You don't have all the information. It comes to you, somebody's trying to sell, and looking at the companies, and you don't know if you're going to have the run's going to be oversubscribed. But what you've seen as well is that if then at some point you start to think about your portfolio and think about the strategy to exit your portfolio, then you become actor of that exit. And you can actually define a clear strategy, look at all the different companies, eventually know which company has potential for what, and decide in advance what you're going to do. That's number one. And in the second case as well, what you can also do is, and what we did also at GreenTech, is that we managed at some point to restructure our portfolio to be able to exit in bulk a part of our portfolio. So there is strategy that can be implemented to create exit or partial exit. And that's why we think that it's quite important. It's quite important to be able to do that. We did that here by structuring our portfolio in SPV. We worked on the companies by doing the strongest portfolio management, but in the same time, we've been also working on the investors, because a lot of people forget that the work that you do by supporting the founders, by supporting the company and getting there to the point where they can have an opportunity, there's also a similar work that you need to do on the investors, because the investors that will seize that opportunities and will allow that eventual secondary sales will have expectation of information, expectation of structures, expectations of return, that where the information needs to make him feel comfortable that you're going to be able to make it happen. Recently, I talked with an investor, and he was mentioning that, there's some companies where I will be interested to invest, but when I see that there's a challenge of governance and this, all the different elements where that are not systematically taken care of, remove the opportunity for exit. And that is exactly what we see as being active at structuring the opportunities, working with the startup, but also working toward the investors to build an opportunity that matches the investor expectations. And in the same time, identify the investors that match those opportunities. So here is the case of the SPV, an SPV where we had an interesting return. We had the opportunity to build relationship with investors, and we had the opportunity to exit partially. This is not like a very short-term period, because people are saying that, yes, I would like to sell my shares. I already have some cases like this. I'd like to get more shares by investors, but it's a work in progress, because when you start working with portfolio management and working with companies and investors, basically you provide a guarantee in terms of the quality of the information. And that role is actually the role that Zeitec sees to fit, because there is a challenge of trust between the owner of the investors who wants to convert paper into cash and the new investors. And that by doing a proper portfolio management, by executing a clean strategy and being able to match the needs of the different stakeholders in the transactions is one of the roles that Zeitec is building through the portfolio management. I have the feeling that there is some questions that popped up.
We're going to take questions. We're going to take questions.
Okay.
I just wanted you to wrap up. We've got a Q&A.
Okay, perfect. So this is some of the, this is some of the situations. This is some of the situation that we had. This is some of the situation that we had with GreenTech. And I think that there's a last case, and I think this is where more Ben was supposed to take it. We want also to show what's happening now, not experience, good or bad experience that happened in the past that led to us today, but some of the experience that we have now and that we're implementing to show that it's a reality. That's actually what's happening when you really get involved in supporting companies with a proper portfolio management. Ben?
Yeah. So obviously, I love the examples Erick gives about his experience at GreenTech, because much like what investors look for startups are you creating this startup based out of a problem that you felt? This is something that Erick really saw and took the lead on, and it's been a fantastic journey to be working with him and following the experience he's had. What is Zeitec doing today? Well, we're implementing the playbook. We've got around 150 portfolio companies under management, and we're actively implementing the playbook to guide, grow, and exit assets within that portfolio. I'm going to give a current case study, which again is going to focus on secondary as a pathway to exit. This is a real case study. So this is currently happening. We obviously cannot share the startup's name or the investor or any of that information because it is ongoing. But we have a startup in portfolio that is raising a Series B. The investor that we have, for whom we are working, invested $70,000 in 2021. This startup is targeting 20 million, and they already have 12 million committed. So with ABAN, we sort of were talking about what is it that we can do to facilitate filling this round for the startup, and hopefully be able to bring an exit opportunity for this investor. And through that, we've identified an institutional investor that would be willing to invest 10 million, which would put this startup's raise at 2 million over the targeted raise, so 2 million over subscription, which would facilitate and allow for the angel investor to be able to exit. So the work where we are right now in the case study is we're doing all of the steps that we just talked about with you that have to be done. We're ensuring that within the angel investors' investment, that all the LPs are aligned and are in agreement. We're making sure that any legal documentation, due diligence is in order and is ready to go, so that, like the example that Erick gave, we are not, this angel investor is not unprepared when some other investors who might be on the cap table and want to exit are more prepared and take their spot. We see the exit prospect here. We do these assessments all the time when we have exit opportunities coming up. We see it as a strong exit prospect. That doesn't mean it's going to happen. Again, this is not going to happen on its own. We have to ensure that all of the steps necessary, consensus, preparation, readiness, and quick decision-making are ready to happen. But our work really around this case study has been bringing in, helping to connect the startup to this other investor who we know could not just fill the round, but potentially oversubscribe. We had other investors that we could put them in touch with who we thought might be able to put 3 or 4 million, 5 million. And, if this 10 million investor wasn't available, we probably would have connected them with that, because our goal is still, of course, to help the assets grow. But given the opportunity that there's an investor ready to write a $10 million check that would lead to a 2 million oversubscription, we wanted to funnel our efforts towards making that connection and making that happen. So this is a current case study to give you all an idea of how we do what we're doing. Next slide. So we have some key takeaways, and the key takeaways we want to present are really actually about you all, the responses you gave to us, how they match up to the responses that we're hearing every day on the continent from investors who are working with Zeitec, and how they match up with the elements that we talked about are required. So from your survey responses, the really interesting thing, and we've had our team in the background just analyzing these as we've been going through the presentation, is these figures almost exactly match up what we're seeing across the board on the continent. Almost everyone is trying to do something to manage portfolios. Almost everyone is expecting at least a 5x return. Almost everyone sees the lack of data as the biggest challenge that they have in portfolio management. But half of people are trying to spend time mentoring, coaching, and following up with startups. So what does that tell us? It tells us that the issues that you all are facing, you're not facing them alone. You have the people in this room are also facing them, but you have people who are not in this room today, all across the continent, who are facing this. And what it also tells us is that if we think of what the Zeitec Playbook is assessing and is saying needs to be put in place, we need to have a strong collection of data, right? Matching up to this problem. We need to have some kind of a strategy and de-risking of portfolio based on data coming in. That links back to the targeted return. We need to have something in place to be actively, consistently coaching founders into providing this information, managing portfolios, and we need to have the capacity to expand our ability to support, mentor, and coach these startups. Because as individuals or even as VC funds, we certainly just don't have the wherewithal to do it ourselves all the time. So those are our key takeaways. TD, I want to pass it back to you to MC this next phase, which is really jumping into the Q&A.
Okay, fantastic. Thank you very much. And thanks for that wrap up. The first question is from Octavius. And it says, what are the top 4 portfolio performance signals, KPIs to consider rebalancing and prioritizing signals to look out for to help you decide which startups to give less versus which to give more? Ben, we had this conversation, remember?
I do remember. Do you want to take this one first?
No, go ahead.
Okay, so I'm going to parse out this question into 2 questions, if that's okay, Octavius. The first question I'm going to answer is, what are the top 4 performance signals or KPIs that we want to be looking at for rebalancing? So it's a very good question. The first thing I would say is that it always depends on the sector of the startup, right? So if I'm talking about a B2B SaaS startup versus a biotech startup, what I expect to see and what the KPIs are that I'm monitoring are going to be a little bit different at early stage. But sticking with B2B SaaS as the blanket, because most startups that we see on the continent are falling somewhere, even if they're in different sectors, under the B2B SaaS model. Typical portfolio performance signals that we're looking at are, 1, are we seeing revenue growth matched with lowering of customer acquisition costs and lowering of customer churn rate? So those are 3 metrics, but they actually kind of tie into one metric, which is essentially telling us, is this startup finding a way to grow its revenues while reducing cost and reducing the number of people who thought they would like the product but don't like the product or don't want to pay for it? That's a really key combination of 3 metrics, because it, 1, tells us if they're on the road to product market fit, which is essential for any startup to even begin to think about going into a high growth stage. But 2, it also tells us, are these founders, because at the end of the day, startups are also mainly about founders, are these founders figuring it out? And so when I see a startup that has revenue that's growing, but over 6 to 12 months, I don't see any change in customer acquisition costs. I don't see any change in customer churn. What it tells me is that these founders don't have that it factor, that resilience, that attitude to go and optimize and change and iterate and improve. So I could see revenue continuing to grow, but if I continue to see the same drop off in customer in number of customers, customer churn, and I continue to see the same amount of money that they're putting in to acquire customers, I'm seeing a startup that is not adapting. So that factor of 3 is one that I really like to look at. Another one that we really, really like to look at, which is super simple, but it's on the qualitative side, and that's why I want to bring it up, is how fast is this startup moving? So when I talk to a startup, one of the first questions that I'll ask when I'm in a meeting with them, and we take meetings with our startups in portfolio quarterly, I will ask them, okay, before we even talk about your targets, your goals, your hopes, your dreams, tell me chronologically everything you've done in the last quarter. And if I hear a startup saying things like, well, we looked at this, we really did some discovery, and then we kind of pivoted into a new strategy we're thinking about rolling out, then already what I am earmarking is that this startup does not move with enough speed to be able to survive the startup funding journey. They take too long to learn, to adapt, and to grow, given that the funding cycle for startups is relatively short. You get some money, you have a little bit of time to figure something out and show that you figured something new out. So that's a qualitative metric. And I want to bring up the qualitative to show that, like, yes, we want to get the KPIs in the KPI sheet. And those 3 I mentioned, the combination of those 3 is super important for early stage. But I also want to get the qualitative to find out, like, are you moving fast? Are you learning fast? Are you adapting fast? And if you're not, then essentially from a Zeitec perspective, 1, we're going to give you that feedback. We're going to tell you, you need to be moving faster. But 2 is that if I see quarter on quarter, the same attitude persisting despite us sort of giving that feedback, what I'm going to report back to investors in our investors report is prognosis on this startup is not great, because what we're seeing is a startup that just doesn't move quick enough for the startup journey. So Octavius, that's not fully comprehensive, but hopefully answers a little bit on that question. And then as far as then deciding which startups to give less or more time to, at the beginning for Zeitec, we assume that we are going to give every single startup that comes in portfolio the same amount of time. And it is through the journey of looking at, are they growing in a way that gives us encouragement? And are they showing that they have what it takes to continue to level up? Those 2 sort of examples of metrics I give you, they feed into what we have internally at Zeitec as essentially a tiering methodology of where we place startups based on metrics coming in, those qualitative conversations. And so if I'm seeing a startup that is growing their revenues, reducing customer costs, they are finding really creative ways to create partnerships that help promote themselves. They're doing a lot of things that are seeming to grow. They're moving fast. They're honest in their conversations about telling us, hey, we did this, it didn't work, so we pivoted and we did this. We're going to look at them and say, hey, these guys have really good underlying numbers that are trending in the right direction, but they also have the right attitude. We need to keep giving these guys time. We need to keep asking them, where do you need support? Is it in fundraising? Is it in growth? Is it in ops? Is it in HR recruitment, helping to place someone in your company? So those kind of factors are going to be what allows us to create this tiering methodology of tier 1, tier 2, tier 3 startups, and how we allocate our time. TD, anything? I'd love to hear your perspective on this as well.
I would rather take the questions that are starting to come up, because there's a whole Jeffrey, are you there? Because I'm also conscious of time. Okay, and what I'll do is, if you guys have any questions, I think the next slide shares our contact details. Please get in touch. Okay, that's what I'd like to leave you with. Okay, is get in touch with us so we can follow up with you. We are here to help. And what I'd like to do is actually, I'm trying to figure out, Jeffrey, are there any other questions?
None so far. None so far. If anyone has any questions, you can just kindly put the questions in chat and we'll highlight them on the screen.
Okay. I did promise you I'd get you out of here on time. We're 2 minutes to the end. So I would like to thank everybody who does Zeitec manage a fund, or do you provide services for a fee? We actually, Bob, we do both. We have access to quite a number of funds. Okay, so for example, I'm an LP, okay, to the Ventures Platform Fund. I'm an LP, okay, to a couple of other funds. I'm also an advisor to Launch Africa. So we have access to funds, including Catalytic, but our fees to angels who are local, members of ABAN, it's actually carry only. So we waive the management fee, okay, because of ABAN, but we then just take carry. I trust that helps. I'd like to bring it to a wrap. I'm going to hand over to Jeffrey. My question is on the exit support engagement. I'd be interested to learn your experience in terms of investors' openness to sales shares and value attributed to the sales share. I'm not sure, Victoria, I fully understand what you mean by openness to sales share and value attributed to the sales share. If you could sort of explain a bit better. What do you mean by openness to sales share?
Maybe I can help you today. If I understand properly, your question is regarding the value of the transaction. And indeed, it's actually a challenge.
Can you double check that that's what you means?
Let me see.
Hi, I don't know if you can hear me.
Yes, we can.
So two things. Earlier you talked about subscription versus sales of shares, which is selling to another investor to exit. And then the value attributed to that sale, are they happy to do it at the subscription price, which is money going into the company, versus you've been around, I'm capping your exit multiple at this, and so this is what I want to pay on this transaction. What has been your experience?
Okay, so now you can answer.
So basically what we see is that experienced investors will every year will evaluate the value of the shares, taking into consideration that there is fundraising or not fundraising. And that's actually one of the biggest challenge that there is, because if there were no around, then you need to take different metrics, look at the market, and come to a conclusion in terms of what the shares are. So, but in most of the case, you have a fundraising and then you have another subscriptions. And at that moment, this is usually the value of the shares of the round that will be considered. And in most of the case, I think people will apply a discount on that value of the shares for the liquidity opportunities. So you have a lot of investors that will consider exiting at that in those conditions. There's a lot of investors that will consider exiting in those conditions. The biggest challenge is more to the access of the information at the proper time, and for the investor that will have the opportunity to sell his shares. And the other challenge will be for the investor coming in to make sure that he feels comfortable with the governance, because when he's buying shares, he's joining a new group of investors. I hope that helps.
Yes, it does. Thank you.
Perfect. Thank you, Eric. Any other questions, please? Cool. On that note, I shall hand over to Jeffrey of ABAN to please bring this to a close. Thank you very much, everybody, for being here and for listening.
Hello, everyone. Good evening. I hope you can all hear me.
Yes, I can hear you.
Yes. So just to go forward, so we have some upcoming events. We have our international investor meetups coming up on the 7th of September. Then we have the local ones coming up on the October 5th, 2023, with Tech 7 African meetups. And paramount and first and foremost is the main summit coming up in Cape Town in South Africa from November 30th to December 1st. So members of this masterclass can access $100 discount for the summit tickets via our discount code at ACES webinar.
It's not showing. It's not showing. We can't see it on screen.
Oh, wow.
Yeah,
What we're
Jeffrey,
seeing is contact Natalie Miller.
Jeffrey, please present the
Hold on.
document.
We can see how to contact Natalie Miller.
Let me look at that again. Share the screen. Window. Yeah, can you see my screen now with the discount code?
We could always see on this screen. It's just we couldn't see it was on the wrong slide.
Oh, sorry about that. So the discount code for $100 off is ACES webinar -100. So you can go to our website at www.africainvestorsummit.com to purchase your ticket. Once again, the summit date is from November 30th to December 1st. Okay. So once again, thank you all for tuning in. Thank you for attending this masterclass session and do have a nice evening. Thank you all from ACES and the Zeitec team. Good night and have a nice day.
Y'all take care. Cheers.